In our last blog, we talked about how to use early warning signs of financial distress to protect yourself from problem credits. Borders Group, a struggling retailer of books, was our example. We think there are 6 key warning signs, and last time we used 3 of them to analyze Borders: falling revenues, growing losses, and increasing working capital. Let's take a look now at the next 3: rising debt, decreasing liquidity, and struggling management. Rising debt. Borders' debt has actually been falling. It totaled $507 million in 2007, but only $282 million in 2010. The reason for that is that the entire company's been shrinking. Total assets were $2.6 billion in 2007, but only $1.4 billion in 2010. Borders has been closing stores and selling off foreign operations to try to get down to its profitable core. But the company's reliance on debt financing has been growing fast. By the end of 2010, 64% of its long-term funding was in the form of debt. And Borders' debt mix has been changing too. More and more of its debt is short-term, up from 30% in 2007 to 39% in 2010. As its equity capital is disappearing due to net losses, Borders keeps replacing it with short-term financing. Decreasing liquidity is our next early warning sign. Borders' increasing use of its short-term bank lines puts pressure on its liquidity. Cash and unused borrowing capacity barely exceeded short-term debt in 2007 and 2010, and failed to do even that in 2009. And when you look closely at Borders' sources of liquidity, you see that many of them just aren't sustainable. Shrinking the company has generated over $330 million in cash for Borders from asset sales and cuts in working capital over the last 3 years. But the company can't keep doing that without liquidating itself. Borders stopped paying a dividend in 2008, and that's generating $25 million in cash savings a year. But eventually, Borders will have to pay one, as most U.S. public companies do. Borders also got a $43 million loan from an investment firm called Pershing Square. But it was unusually expensive, with a 10% coupon and warrants for 10 million shares. It was not an ordinary capital funding. Our last early warning sign is management. There were plenty of signs of trouble with management at Borders. For one thing, management kept changing Borders' strategy. In 2008 and 2009, it was to shrink to a profitable core. Then, in 2010, it was to grow by making a major acquisition. Management seriously considered making a bid for Barnes & Noble in 2010. Another thing was turnover at the top. The CEO and CFO both resigned in 2010, and 7 directors left the board. Finally, management withheld information. Companies in trouble need to update investors, lenders, customers, and suppliers constantly. Borders did little more than the minimum reporting required by law. Companies are always getting into trouble. You need to be able to see the problems before they become severe. If you can anticipate trouble in time to act, you can reduce or even eliminate your exposures, improve your security position, and even enhance your returns. The early warning signs are the best tools available to help you do that. So remember to keep a lookout for falling revenues, growing losses, increasing working capital, rising debt, decreasing liquidity, and struggling management.